Well, it's great to be back with you with a black hole of real estate. And this week, we want to talk to you about what it looks like as we head into the fourth quarter of an event filled 2023. You know, one thing that stands out to me is that we called the bottom of the market as November 1st of 22. And there were some really big impacts from hurricanes September 29th, 30th, and that part of 2022, which led to it in Florida being a little bit different than it might have been towards the end of the year. And as we head into that time in 2023, we've already seen one major hurricane make landfall in Florida, and there's a number of other things occurring throughout the United States and Canada for that matter, with wildfires and storms and things that would live rent free in home buyers and investors' minds. So those things are always going to go on. And there's always health concerns, and there's elections and all these distractions. But if we set all that to the side, what we would find is that the prices right now for homes are about what they were last year. And they've been relatively stable, if that's the word you want to put your arms around right now. Haven't changed a whole lot in the last year. And there was prognosticators insisting that this was a crash waiting to happen, and we're going back to 2008, and it didn't happen. And we've consistently told you that it wasn't going to happen because this market was different. Interest rates, were 7%, and there's mention, well, hey, maybe it'll be 8%. Well, it hasn't stopped the market. And it's for the same reasons we consistently been talking about, is there is a ever-growing number of people looking to move to other areas, and states such as Florida are extremely popular right now. They have been for years, but there's a different motivation for many people to move to the area. But I don't know, sunshine and no state income tax, those are not stopping. But there's other areas of opportunity and growth which I think the people continue to look for, and they're running to, not from. So that doesn't stop. And despite the fact that we are a little higher in the inventory, but not much, simply offset by the cost of ownership if you're financing, but the prices just have remained stable and continued. And, it's likely to continue that way. There's been a lot of jitters, and there's been a lot of things that have conspired independently to affect the real estate market, but it hasn't. So as we peer into the fourth quarter, what might take place? I believe, and I've been saying it for a long time, that you'll see an easing of interest rates, and my guess is somewhere around the first part of November, when we're 1 year to national elections. I don't think that's out of bounds. And if they take another rate hike right now, then I believe that they'll, okay, hey, you know what, we can ease off a little bit. So sometimes it's like the grocery store where they raise the price and then they say buy one, get one free, or buy one, get one half off. And I think that we're setting the table where it'd be very easy to lower interest rates by just raising it a little bit more before you get there. So, that's absolutely one way that this might happen. I'm not convinced that all these raisings of interest rates have actually curbed inflation. We'll see. It's probably for the economists to figure out, but it doesn't appear that way. I don't notice that the things that I purchase at the store or at the gas pump or those other things, I don't notice those prices coming down. I just know that everything is costing more, and also anything that's financed for people purchasing or people on business lines of credit or construction companies that borrow on lines, the cost of their money's all gone up. And if the cost of money's going up, I'm not certain how they're supposed to make their products cheaper if it costs more to get the money to develop those products and get them to market. So I don't know if that happened. So I believe the interest rates will back off by the end of the year. Maybe not dramatically, but they'll begin to ease off. And if it's not politically motivated, it might just be that there's really no other path to go because they've raised interest rates high enough that there should have been some effect, but it hasn't stopped the market, and things still cost more. So layering some economic data on top of the real estate market findings that we're studying right now. So rates will come down a little bit. I believe that inventory will ever steadily increase because it has this year. Just not leaps and bounds that we might have hoped. And as we get into the colder months, it's snowbird season, I do believe that more people will really look very closely at moving from cold weather states to warmer weather states because the cost of energy, whew, yeah, I don't think anybody's electric bill went down this year. And so if you're driven by electric or oil heat or something like that, let's say in the Northeast where it's super cold, or other areas that have similar climate, it's going to be really, really expensive. More expensive than years past. And I think it's going to cause some people to take, yet another look. Like, is this the year that we make a move to a warmer weather site? So I believe that will drive as many or more people that have been coming to warm areas every year. You see, it's not just the economic indicators, it's the quality of life indicators. So I believe that is something we could watch for. So if you're stacking and racking, interest rates probably going to soften in the fourth quarter. Inventory will go up, sales will remain the same, price will be about the same, and there'll be an increased appetite for people moving to a warmer weather area because economically it's going to get tougher to pay for the goods and services that you need to live on and stay warm because the inflation is not keeping up. Well, inflation is far greater than the wage increases. So there's less money to work with. Something's got to give. And that's something that causes people to move. So what else can we envision changing? Let's just say between now and the end of the year. Well, we've talked about the few things that probably would be readily available to talk about with a lot of data and out there. But investment programs. Investor loans. This has been a growing concern. The lenders are nervous about lending money to speculative investors. So if you're thinking of purchasing a property to produce revenue, rent it to make a profit. If you're leveraging yourself in such a way that you're putting as little down as possible, maybe 10% instead of 20% on an investment property, you're going to feel an impact. And I've seen 2, 3, and 4 points added, not because of interest rate or credit, just because it's a product that's almost toxic right now to a lot of lenders. They simply don't want the risk of investor loans with low down payments where the purchaser is dependent on a rental income to pay for the mortgage. So if you have the ability to purchase a property as a second home or an investment home, and your qualifying income can support that without the rent, you might be able to avoid some of those points. But if you're projecting rent as part of the way you're going to repay that, you are going to see a gigantic amount of points. And when you think about a property at 100, 200 grand, it might be 1 or 2,000 per point. It might impact you 5 or 6 grand. When you're buying at $500,000 and you just achieved $15,000 or something like that, just for the pleasure of getting a loan to pay more interest back, that's rough. And we're seeing that. We're also seeing a higher interest rate, so additional points just to get the program. Now, let's just say your credit was a little bit off. That would also drive your interest rate up. But it's the upfront discount points that are costing you the money just to get the loan. That's the price of entry, because they do not have an appetite for that type of loan in this market right now with the volatility that we're facing. And if you think about it, someone who's dependent on rental income, if something were to happen where people were traveling less, not stopping, but just less, there's going to be months where the property owner is going to have to dig in their pocket to pay for that mortgage payment. And this is what the banks are worried about. If no rent comes in for a few months, can the person who's marginally qualified for the investment property loan, are they going to be able to have the cash and the reserves to sustain this? And what if it wasn't had anything to do with the rental market? What if it was just a condo where they had a balcony project or an engineering project or something that was very costly? It was going to be a special assessment for $5, $10, or $20,000, but also make it where you couldn't rent the place out for 6 months or a year. You see, this is what the lenders see and what they're concerned about. It's less of a real estate market driven pricing sensation, more it's a structural situation. And when you think about the number of hurricanes and storms that come to places like Florida, and the tragedy and collapse in the condo building of Miami, still fresh in many people's minds, those engineering reports are coming out for the safety and the well-being of all the other condo owners and people that live there. So these are taking place. The bank's got a lot of smart people working for them, and what they really want to do is mitigate any type of risk. They want to make money. And right now they see this. So an investment property where a buyer is using the rental income to qualify is to see a lot more points. It just is. And the reserves are asked to be higher, liquid reserves, with the banks thinking there could be, in some buildings, some shutdowns where they can't rent it out while the projects are being completed. So reserves for a special assessment, reserves for loss of rental income to be able to keep making the mortgage until it's all worked out. So this is where it's coming from. And that's why as an investor, many people are finding it's too costly to get into this market. Now, advantage cash investor, because they don't have to deal with any of that. They have the cash, they just pay for it. There's no points, there's no higher interest rates, they just go buy it. So advantage to an investor who's investing with cash or has the credit and ability to make the payments without the rent, big advantage to them. So if you're in the first category where you're dependent on the rent, it's going to be more expensive. It may cause you to not make the purchase at all. Numbers won't make sense. If you're in the second category where you're paying cash or your income is sufficient where if you've got no rental income, it wouldn't matter, then advantage to you. And as you go into the fourth quarter of the market, that's what I'm watching for, is where we end up with these investment properties. Because I think they're actually going to sell. And I think investors that have cash, I mean, not only is cash king, now it's the difference between buying and not buying for many people is having the cash to do it. The way that the savvy people that want to do these investments are finding the money is home equity lines of credit. Because typically on your home mortgage, you don't have to jump through all these discount points because you're just getting cash to do something with it, and that's all there is. And then you can go buy a property for cash, and that is the solution if you are a little skinny on the qualifying, is use your home equity to get the property. So that's our forecast going into the fourth quarter. It is also one twist on the market with investment properties and what's going on and why things are just a little bit different right now. And we'll be watching it. Those discount points are going to be there until inflation is curbed. So if you're an investor looking for those type of loans, we need to dig in and help you find some different strategies. Home equity certainly is one. Waiting probably is the other, selling off a different asset, or maybe moving out of some stocks to acquire the cash. Those are probably the 3-4 most prevalent ways to make that purchase that you're thinking of making. I hope that this was helpful to you, and we definitely look forward to your comments. Definitely subscribe, and let us know what you think. All right, this is Ron Wojciechowski. Thanking you. I will see you next week on the Black Hole of Real Estate.